Stock Market Trading Level 2. Trading IPOs, Day Trading and Swing Trading. Today we're going to discuss day trading and swing trading of IPOs or initial public offerings. The trading of IPOs occurs when a privately held company opens its shares of trade and makes them available to the public for trading on public markets, like the New York Stock Exchange or NASDAQ. In doing this, the company is hoping to raise money or capital. The company can offer secondary opportunities of shares in the future. All of this should be common knowledge by now. However, how do you make money on those IPOs, and swing trading is best reviewed here. Day trading IPOs. The largest stock market winners usually make their key money amount moves within a limited number of months or years of their initial public offering. Therefore, it compensates to identify and track companies early, before or as they go public. Before buying IPOs, traders should know that recently listed shares have their own set of risks and opportunities that must be contemplated. The IPO Money Amount. The IPO Money Amount is the official money amount that the investment bank underwriting the deal will use to sell to the large institutional investors for the primary trade of the stock. Regular people can also purchase at the IPO amount under special circumstances. For example, if you have a stock trading account at the same bank that is underwriting the IPO. For example, Morgan Stanley was the lead underwriter of the Facebook IPO in its 2012 debut. They allowed some of their clients to purchase at the $38 per share opening trade. Unfortunately, some of those investors lost funds as the stock hollowed sharply in the months following the IPO. Analyzing the IPO. It's difficult trading upon established companies with thorough backgrounds. But trying to trade on IPOs is even harder, especially when you're dealing with new companies with virtually no history. 2 points of interest to look for is how the management team will use the funds collected from the IPO and what is the quality of the underwriters. Many operating managers will look at the performance of smaller companies and follow their business plans to generate similar revenue. The IPO can have many sources of data that act as decoys, so paying close attention to the management team in the past years is one way to accurately find data on the company. The successful companies will be supported by larger brokerage firms who can endorse well. Smaller firms may be willing because they will underwrite anyone. Post-market. Once the IPO stock has begun its trading, it can be bought or sold like any other. In fact, the liquidity is so high on the first day of an IPO's trading, it is frequently easier to buy the stock. For example, during Facebook's IPO in 2012, more than 80 million shares were bought and sold in the first 30 seconds through high-speed computer trading. Any investor or trader with access to a stockbroker or trading account could purchase shares on the open market for the rest of the day. Stock pop. The big enticement of an IPO is that it will have a key pop on its first day of trading. In 2011, the shares of LinkedIn climbed 109%, from $45 to $94.25 on the first day. IPO investors hope to achieve these massive gains on the first day of trading as the public market genuinely confirms the company's value. During the internet surge of the late 1990s, huge IPO increases occurred frequently. Flipping IPOs. Some people are on the bench about the practice of flipping. Depending on where you end up will determine whether this will be a practice you use or not. Flipping is the system of reselling a hot IPO stock in the first few days to earn a fast profit. This isn't as easy to do as it sounds, and you probably will be strongly discouraged by your brokerage. The logic behind this is that companies want long-term investors to hold their stock, not speculative traders. There are no laws that inhibit flipping, but your broker may preclude you from potential offerings. Of course, established investors flip stocks repeatedly. It is part of their routine business. Being aware of this double standard will help you later on. Because of flipping, it's a good rule not to buy shares of an IPO if you don't get in on the initial offering. Many IPOs that have big gains on the first day tend to come back to earth as the institutional investors take their profits. Swing trading. Swing trading is a short-term trading method that can be used when trading stocks and options. Whereas day trading positions last less than 1 day, swing trading positions typically last 2 to 6 days, but may last as long as 2 weeks. Traders look at bearish and bullish patterns over a period of a few days. This period of time can be very stressful as prices vary, so it's important to leave emotions aside. Traders are hoping to find the long half W sign with them buying as low as possible. Then, over a period of a few days and a slip back, it soars high, having done some trading algorithm, technical analysis, and fundamental analysis. For swing traders, identifying the entry and exit of a trade is the primary challenge for all their strategies. Fortunately, swing traders don't require perfect timing to buy at the precise bottom and sell at the precise top of price fluctuations to make profit. Small, consistent profits that encompass a strict money management system can multiply earnings over time. Risks in swing trading are equal with market theory in general. Risk of loss in swing trading typically rises in a trading range or sideways price movement as compared to a bear market or bull market, which is obviously going in a specific direction.